Good afternoon, everybody. Thank you for joining us today. It's our pleasure to have David Kivitz, the CEO of Xtraction Services. We're really excited to be engaged in working with David, especially given the space that he's in. Xtraction High Levels is a specialty finance company providing extraction equipment to cannabis and hemp manufacturers. So I'll let David provide you with a little bit more background on himself, and then we'll kick into the presentation, and we'll take question and answers after. Thank you.
Nima, thank you for the introduction. Really appreciate everyone showing up today, both in person as well as not here in person. As mentioned, I'm David Kivitz. I'm the CEO of Xtraction Services. What we have built is a large-scale equipment leasing platform and consultory services for any oil processor or manufacturer in the entire cannabis and hemp industry. The story is largely focused on the United States because we have a large customer base there and there's a very large opportunity there. Although I do like to point out it is a global opportunity. The equipment that we distribute can be deployed anywhere. The financing that we have can be provided in almost any jurisdiction. And so it really is quite an unbelievable opportunity. By way of background, I started my career in structured credit. I worked for a company called Capital Source. I then worked for the largest alternative investment advisor in the United States, Hamilton Lane Advisors on the buy side, and finally at a family office in New York before leaving and going out and starting my own entrepreneurial endeavor with a partner. In 2009, after the US housing market crashed, partner and I moved to Los Angeles. We bought up about $100 million worth of distressed residential land, subdivided finished lots, and launched a full-scale production home building company to build out all of that inventory. Between 2013 and 2017, we generated about $250 million in revenue, about a $50 million a year stabilized run rate. We were the third fastest growing company in 2015 in LA, private. We were top 100 private fastest growing company in 2016 as well. And I was the managing partner of that company who oversaw all of the financial guidance, financial oversight, acquisitions, and asset management for the entire business. So thank you again for joining me today. Talk a little bit about Xtraction Services. So as noted, we like to focus on the ancillary segment of the business. It's a pickaxes and shovels play along with specialty finance as an overlay. We provide equipment and we help finance it. Although we are not the manufacturer of the equipment, we distribute for manufacturers. Why did we call the company Xtraction Services if we're a finance company? The market in cannabis is projected to move to one of oil-derived or oil-based products. So I think most people are aware smoking or smoking the actual flower is a declining market share within the space, and things are moving to topicals, lotions, vape, edibles, consumables. Anything in that vein requires oil processing. And so we like to focus on financing the equipment that is the critical mission equipment to produce that oil. And that's why we focused on it. So you won't see us financing cultivation equipment. We're not interested in that segment of the industry. We start from the time of pre-processing all the way through a packaged good. What are the industry challenges today? Particularly in the United States, there is limited capital available. There are some groups out there raising equity. There are even fewer out there raising true debt. We elected to start a debt servicing platform by building a large equipment financing business. We had looked at a few different opportunities. We kept noticing the use of proceeds in those opportunities was always equipment. Rather than trying to pick a few winners, we thought we would generate enterprise value by near-term paybacks, always secured through the equipment, and making sure that we had the ability to deploy that equipment effectively with point-of-sale financing. So for a customer, they could get the equipment they needed and didn't have to go on a roadshow to go and raise substantial amounts of money. It was right there for them when they were ready to acquire it. Secondly, the equipment is very costly. For those who have looked at extraction facilities, those costs can start at $1 million and go up from there depending on volumes and how big the facility is trying to be and the type of equipment that they're trying to provide. Thus, financing makes it much more achievable for them to actually ascertain that equipment at the time that they need it. Thirdly, this is something that we have the first version of. The equipment in this space is constantly evolving. Technology obsolescence is something that people talk about. And if you go look back in Colorado 3, 4, 5 years ago when companies started getting set up, that equipment is now dated. It's stale. They cannot be low-cost producers working on equipment that's V1 if there's now a V5. So how did we deal with that? Well, we created an industry-wide trade-in program. The manufacturers don't have the ability to take back equipment. We do. We like the used equipment market, and based on the returns that we've already generated from the equipment by the time we take it back, we don't mind either leasing it out at a lower cost or selling it off for the parts or refurbing or upgrading that equipment. What does that mean? Well, in the industry right now, you have all forms of different type of extraction and post-processing equipment. Ethanol equipment, CO2 extraction equipment, hydrocarbon equipment, microwave extraction technology. Then you have refinement equipment, rotary evaporators, distillation units, things that take crude oil and move them to a further refined oil. And all of these products are made by a variety of manufacturers. And there is no one manufacturer that produces all of those products. And so what you end up with is a situation where at the end of a lease, that customer can take the product, give it back to us for a stated trade-in value that they knew at the time that they took the lease, and they can trade one manufacturer's product for another manufacturer's product. It's a great market for us because it also locks them into a new lease. So we take back something that we actually can create value from, and it locks them into a new lease, which is very good for the customer. And of course, looking at the fourth point, they will continue having to upgrade and refurb technology to remain competitive if they want to be a low-cost producer. There's going to be a fight to the bottom over time as supply starts to meet demand, and that means that they're going to have to focus on cost and efficiency. Today, that's less important. That's starting to become more relevant in markets that we've seen mature. So obviously, we provide ourselves and pretend to be the solution to all of these issues. So we have a high-margin business model. One, we make money in two ways, and so that way the customer doesn't feel all of the return that we earn. We effectively get paid as a distributor or a wholesaler for equipment manufacturers. They're starving to find customers, and they're starving to find guys who can actually finance their customers to help sell their products because they don't have enough capital to do it, and their customers don't have enough capital to buy everything they need. So by us agreeing to finance the customer and market their products for them, we get paid a rate from the customer for the lease, and we get to acquire their assets as a wholesaler or a distributor. Two, we have a management team that's well-versed in specialty finance. As I mentioned, I started my career in structured credit, not my first endeavor in the entrepreneurial world, and I'll round out the balance of the team later, but you'll see we have a very senior team that has done this many times over. It's a highly scalable platform. Unlike our customers, we do not need to set up infrastructure in every state that we operate in. We're a finance company, and the manufacturers that we support, they do delivery and on-site service. We're there to provide exceptionally more service surrounding the entire production line. So you have 3, 4, 5 manufacturers dropping off product. It's our job to play orchestra conductor and support the company to help them bring all of those pieces of equipment together so that they can achieve their final product goal, whether that's distillate, isolate, formulated good, etc. It's very important. It's a proven business model. Equipment leasing exists in every industry on the planet. We're not doing something new here. We're doing something that doesn't exist in this space today. So why is that? Well, most traditional equipment leasing companies have existing institutional lenders that do not allow them to play in this arena. And so by raising funds from outside investors or investors that are willing to participate in the industry, we solve that issue and bring something to the industry that is unbelievably necessary. And obviously there is significant growth potential. One for our product and two within the industry itself. The two will help grow each other. We have 4 methods that we allow customers to buy equipment, and I'll walk you through what some of those are. The first is a direct sale. That is, a customer comes to us, speaks to our extraction team, which consists of and is led by the former lead scientist from Knox Medical, which operates in 5 locations and in Canada. So we have deep expertise in actually operating licensed oil processing facilities, in many cases better and with more technologies than our customers do. So we're giving them a highly consultative sale. In that vein, we are taking that customer, that lead, to the manufacturer, and we're saying to the manufacturer, we have spec'd your product to our customer, and they will allow us for the lead to effectively buy their product at a wholesale price, which we then sell to the customer at stated MSRP. Customer doesn't see that we're buying it for a discount. We have a layaway program, or what we call purchase finance. Same concept. We pre-approve a customer for a certain amount of financing. We then go to after we've underwritten them, we then go to the manufacturer and say to the manufacturer, this customer has the ability to purchase up to blank amount of dollars of your equipment. With that, we again buy the equipment at a wholesale discount, and now we charge an interest rate for purchase financing for the customer. It's usually in the neighborhood of, call it mid to high teens, and a typical layaway deal would look like roughly 15 to 20% down payment against our cost, a low stream of monthly payments to us, and then a balloon payment at the end of 12 months. We have looked at going out a little bit longer on those deals, but typically those are going to be shorter term. We have our leasing program, which is very popular. With that program, we take a much larger down payment, typically 35 to 40% of our cost, which is incredible asset protection from day one. Usually those deals look like 24 to 36 months. Again, same type of interest rate associated with a lease, only the payments on a monthly basis are the same for every month through the balance of the term. And we have a stated trade-in and buyout value of the equipment at the end of that term. We try to incentivize customers to trade in. So at the balance of a 36-month term, you'd have a 15% cash buyout on their original MSRP, or a 20% value to trade in against any type of new equipment that they'd like from anything that we distribute in any of our manufacturers. So they can take an extraction machine, trade it in for a distillation unit. They can take an extraction machine and trade it in for another manufacturer's extraction machine. Or they can just do like Xerox does, and we deliver them the new copy machine every 3 years on a brand new lease. No different than an auto lease or a Xerox or others that have perfected this model. And then we have our royalty program, which is really what sets us apart. I've talked a little bit about our expertise in extraction, which does two things for us. One, it helps us become phenomenal underwriters, and I'm going to talk a little bit about that in a bit, because we do think a lot about mitigating downside risk and credit quality. But it also allows us to charge more for our services. Why is that? The royalty program, for which we've already signed 3 royalty contracts, is a fully consultative service to set up your extraction facility. We do your floor plans, we calculate all your power and load calculations, we help train your team, we provide all the SOPs, and we spec out the entire production line of equipment or production lines of equipment that you would need to create your end product goals, whether that's distillate, isolate, packaged good, formulated product, what have you. In exchange for that, we take a down payment, we call it prepaid royalty, and then we charge based on fixed cost of manufacturing, which means we get blank dollars per gram of every single gram that comes out of the production line that we've given the customer. It aligns us with the customer. We're there to fully support them. They get minute-to-minute interaction with us. We have a chat group that we set up with every single customer, so we're giving them feedback in their facility effectively in real time. So we can answer any questions that they have, anything that they can possibly need, and it's been incredibly positive to us. And of course, the returns are staggering because we're not just charging for financing, even though we're giving them the equipment without making them pay for it up front. We're providing all of that consultory service that they don't have to go hire, that they don't have to go learn, they don't have to go figure out. We're delivering it to them, and it's a tremendous value add to our customers. And because of that, we make sure that we're giving them high volume equipment that we know is going to ensure that we ultimately get paid what we'd like. I talked a little bit about underwriting, but I just want to touch on it in relation to this, is we think about doing our own third-party certifications on feedstock. We do our own third-party certifications on their takeoff agreements so that we can make sure they sell the product. Why? Their ability to have good feedstock is going to create good output or throughput from the system. Ultimately, that dictates how much value they have to go and sell. Then we want to make sure that they have customers that can actually buy it. Why? Because we want to make sure as we mitigate downside risk that we get paid. And obviously those are very important things to us. So let's talk about what a traditional deal looks like. This is actually a hybrid structure of 2 of the concepts that I just mentioned. We have a deal like this that's in underwriting right now with a customer. So what we focused on here, looking at the top section, is a manufacturer who would sell $1.25 million worth of equipment. That would be his stated MSRP. In this example, we would buy that equipment for $1 million. The customer would not see that, only the manufacturer. Right there, we would start the process by marking in $250,000 of return by buying the equipment at a discount. We then go to the customer and provide them the lease terms. That looks like a down payment in this case of roughly $345,000. Based on our cost of $1 million, that's a 35% down payment on our cost. We're then financing the balance between the $344,000 and the $1,250,000 with an 18% interest rate. That ultimately creates lease payments over a 24-month term of roughly $1.25 million. In this deal in particular, we have a royalty override for that consultative service that we mentioned, but we've protected much more of our downside by taking a lease and a much higher down payment. So we agreed to reduce the royalty payment that they would provide. So in this example, we charge 22 cents per gram. It adds another $421,000 of return to us. So on a total deal basis, we generate just over $2 million in revenue. On our $1 million of cost, we have our full cost paid back in 9 months, and then everything thereafter is to the bottom line over the balance of the 24-month term. Because we get paid back so quickly, you can see what that does on a gross IRR basis. The returns are very interesting. So looking at our current traction and existing customer base, as mentioned, we're not a startup. We have 2 customers in Kentucky. They're both hemp processors. They're both on our royalty program. Kylex is one customer, and we have another that just raised $7 million of equity who has us setting up 2 full-scale production lines on royalty. Going into next year, that equates to about $5.5 to $6 million of annual recurring revenue just on these 2 customers alone, and that means in 2019. Our service contract down in Florida, that's actually the local operator, Grow Healthy, for Ianthus, the business that they own, which is obviously quite a large company. You might think, why would they need to work with us? Because they need folks who are on the ground who can give them that additional support. So that kind of addresses a little bit of why companies need the type of service that we can provide and the brain trust that we have with our actual team. As you can see, we're about to close a purchase finance deal for CO2 extraction equipment in South Carolina, also a hemp customer. We closed a $1.1 million cash sale in LA in Q3, and we have a few other pipeline deals that we're getting ready to close. In no way does this represent the entire pipeline. I'm going to speak to that in a second, but what I do want to point out is, as you can see here, and particularly in the United States, there are 2 customer bases. You have your hemp processors and you have your cannabis processors. Both are interesting customers for us for different reasons. The cannabis customers, they have to reset up infrastructure in every single state. Quality control becomes very important, which means they need to standardize on equipment. Because if they're using different equipment in all different facilities around the US, they're going to have issues with quality control, which means the trade-in program becomes exceptionally valuable to them. So that way they get some value for equipment they've paid for in the past that they can trade up for new equipment now that looks like the rest of their production lines in other places. The hemp processors are interesting customers to us because of sheer volume. These guys can produce an unbelievable amount of CBD oil so long as they know what they're doing. Our customer in Kentucky is a good example, bought feedstock. By the time we refined it, it had in excess of the 0.3% legal amount of THC that allowed them to distribute. So what did they do? They called us. We taught them how to remediate and single out THC so they could remove it. Now they have oil that they can sell, which ensures that we get paid. That's the kind of brain trust that people are paying us for on a royalty contract. They would have to pay for that service outside their company anyway, but instead they have an aligned partner who's aligned to make sure that that happens. That's why that is of value to them. I'm going to talk a little bit more about the balance of the pipeline on the next slide. So here we talk about high-level revenue growth, although I'm going to go through the detailed numbers on the following page, as well as our contract funnel right now. We have 12 customers that are currently in negotiation in underwriting. That means we've received some level of tax returns, bank statements, financials, presentation materials if they've done or have recently completed a roadshow, license verification, real estate verification, all their corporate documents. We go through an exhaustive underwriting process, and then we do things that anyone that fall outside of this industry wouldn't do, as I mentioned before, which are underwriting feedstock quality, offtake agreements, things that folks who have not actually performed extraction capabilities themselves would simply not know how to do. As you can see, we have a very robust pipeline. So our focus right now is completing this fundraising round, securing a senior credit facility, which we're talking to a variety of different lenders about, and ramping up our platform, because today all we can do is cherry pick customers, which on the one hand is good. We have no bad debt, so we've not entered into any bad deals. On the negative side, we have $35 million in equipment need from those 12 customers, which we cannot finance today, and most of them are good customers with good credit quality in businesses that we would actually like to provide equipment. That is the purpose for the financing. That's why we're here. As I mentioned earlier, we go into the year with substantial ARR. We don't need to do many more deals to achieve our $14 million revenue target for the year. That would equate to about 4 or 5 more deals depending on whether or not they are leases, royalty, direct sales, etc. Those obviously have a different impact on revenue. And we expect that you won't see any hockey stick growth here. It's somewhat linear. And we think these are numbers that we can reasonably achieve, no different than we did in the prior real estate company that I mentioned that grew very fast. A couple important things to point out on this slide. Some people are less familiar with it, but in the United States right now, plant-touching companies deal with something called the 280E tax. It means that they cannot write off COGS against their income. That is an unbelievably important thing to understand. By just showing up on a net effective tax basis, we're 20-25% better than any plant-touching company. In addition, because of the new Trump tax regime, we get the benefit of near-term depreciation, which means we also get to write off all of this equipment and depreciate it over the balance of a year. Why is that important? It's important because a lot of companies in this industry are talking about revenue. A lot of companies in this industry are talking about EBITDA. I'm here to talk about net operating income, real profit. And that is what you'll see here in 2019, 2020, and 2021. The tax regime works to our company's favor in terms of business plan. The non-280E nature of our business means we have more cash flow that we're actually generating to put right back into the business, which means we'll have to raise less equity, dilute less, and create better returns for our equity holders. It's extremely important to understand and why we like this type of a business model. As you can also see here, as I said, we project $14 million in revenue this year, which we think is achievable based on what we have in front of us just in our pipeline today. With the financing closed, we can activate those contracts once it's released to the business, and we can go start closing more of our deals. We are in no way stopping our business activities right now. We have existing customers that we're going to continue to close. For us to really ramp requires us to close the financing that we're here to discuss. Here we show some market comparables, both on a Canadian cannabis company basis as well as a US cannabis company basis. We look inexpensive where we're going out to market relative to all of these businesses. So we will be going out at and trading at 2.3 times projected 2019 revenue and 5.5 times 2019 projected EBITDA. Again, I think NOI multiples are important to understand because we're not seeing a lot of companies producing true net operating income, and I think that's ultimately what really sets us apart. That, and I think we can grow much faster than these businesses with a lot more downside risk protection because we own all the equipment. It's always on our balance sheet. We always have the collateral. If a customer doesn't pay, we can redeploy that equipment elsewhere. Talk a little bit about the management team. I've talked about myself a little bit. Brooke Hayes is a dual Wharton grad. He helped build a private equity firm over 25 years that has $700 million under management, not surprisingly focused on specialty finance. Introduced to me by one of my business mentors, who's also one of our advisors. John Conop's our director of risk, has spent 30 years in specialty finance, underwriting every type of kind of alternative lending you can be in. Alex Carroll was the lead scientist that I mentioned at Knox Medical. He oversees our extraction capabilities and customer support. And Andrew Goodman, who ran the entire sales program at BizNow Media before it exited to a private equity buyer. I'm not going to spend too much time talking about the board and the advisors. There's some overlapping names. In addition to John McKay, who's the editor of Xtraction Magazine, ran the entire extraction program at Waters Corp, which is a publicly traded multi-billion-dollar company. He's great for customer referrals. He's also great for manufacturer equipment referrals because he has a very good handle on what equipment and what customers need things, and he knows he can send them to us when they need financing and support. Talk a little bit about the cap table. Today, we have raised about $9.5 million. That includes roughly $3.5 million that was put in by my investment firm and my family. So we have meaningful skin in the game, meaningful alignment. We've done 2 rounds of outside capital, raising about $8.3 million in US dollars. That included a Series B convertible and a Series C convertible debenture, both of which will convert on the RTO. The Series B converts at 80 cents Canadian, and the Series C converts at a 15% discount to the round that we're going out to now, which would price it at 94 cents Canadian, relative to the $1.10 conversion rate in the most recent marketing round. What you'll note about that is we have not tried 2, 3, 4 times each round. We've had paced growth. We continue to perform in the business, and that's the thing to understand. We're not trying to go and swing for the fences. We have a real business that we want to grow and we think can be a substantial enterprise over the next couple of years. Here you can see we're in the market raising $10 million. We show the conversion of the convertible debt, the shell that we have already locked down. So we have a binding merger in place with a shell to complete an RTO. We show the share count that they will receive upon the merger, as well as the financing that we're out working on now and why we're here presenting to all you folks today. Just to wrap things up, in summary, it's a fast growth, high margin business. It's 50% plus EBITDA margins. We get a ton of operating leverage in a company like ours. We don't need a lot of people to run a business like this. We're a team of 12. We will, of course, add people over time. But what we do not need are $300,000 extraction expertise. We have that. And we don't need $300,000 a year guys who know how to do specialty finance. We already have the team that we need in place to do it. Adding more volume in leasing means more processors, not necessarily more experts or highfalutin management teams. So we're effective and efficient on cost structure. That's how we generated the returns we did in our prior businesses. And it's the same methodology that we're going to use here. Talked about an experienced management team. It's what you're getting. You have senior guys who have done this in this industry and outside the industry. We've been both institutionally pedigreed, but we also have entrepreneurial experience. Ancillary cannabis business. We don't have to deal with the ongoing regulatory oversight and cost burden of it. I don't have to hire lawyers to go figure out how to structure a deal to go and be a plant-touching company and move capital to a management company or a real estate company or other places. I don't have to spend any of that money. I'm a non-plant touching business, nor am I subject to plant touching taxes. It's very important to understand. High recurring revenue stream. Obviously, we put out a lease, we own the equipment, and it now produces a recurring revenue stream for a long period of time. Apple is a good example, understands this. That's now why they don't sell you the phones. They put them in your contract and they make you pay for them monthly. That helps them raise the price 10, 15, 20% on what they used to sell. It's an important thing to understand is if they let you pay for it over time, you don't feel the burden as much, neither does the customer, and he's allowed to produce oil, which he can sell so that he has more funds to pay us for the equipment that he didn't have at the time that he looked to purchase it. No different than an auto lease. And it's a global opportunity. Today, we're focused on the United States. We're not going to try and run around and be in every single country just so we can say that we have an international expansion story. That's not our business. We're not looking to be in Africa. We're not looking to be in Malta. We're looking to focus on one place where the opportunity is very large and we can be a dominant player in that space. We think we will have a lot of exit opportunities because one, we have a business that cash flows. It's not reliant on raising new money all the time. And two, it's highly profitable. So you can see we've been covered in a bunch of different places. So we know how to get the word out about the business. That's how we were able to attract capital in prior rounds and why I'm here today. And that's Xtraction Services. Thank you guys for coming and for being here digitally, for paying attention. Be happy to answer any questions about the business.